Hey everyone, Nick Armenis here. This is my investing channel. In today's video, I've got something special for you. I'm going to cover off my favorite 21 stocks for 2021. So I'm going to go through in detail 21 stocks that I think have a really good opportunity to give you some gains in 21.
In today's video, guys, I'm going to show you my 21 favorite high quality ASX stocks for big gains in 2021. So guys, it's the year 2021. I want to show you the stocks that I think are going to have the best growth in terms of performance from a share price level, and also just ideas that I think have some really good concepts behind them that could do really well in the year to come. So guys, before you get into this video, please note that I am not a financial professional and this is not professional advice. This is just my thoughts, guys. I'm a guy on the internet that really loves stocks and I want to share you the ideas that I look at. It's nothing more, nothing less. Please read through this disclaimer and note that if you do need financial advice, please see a professional. Okay, so pick number one is Adore Beauty, ASX ticker ABY. So guys, ABI, I've put the website right there. They're a pure play online beauty retailer and they partner with beauty and personal care brands. So they sell other people's brands and act kind of like a marketplace, right? So they sell a range of products to suit a variety of needs and preferences. Guys, I come from a digital marketing background and I can hand on heart tell you that these sort of products sell really well online. Brands sell well online, so the fact that Adore Beauty sells well-known brands means that they don't need to spend as much on advertising to acquire a customer, right? To acquire a sale. So other brands are having to spend a lot more that aren't selling well-known brands. So these guys have a massive leg up. Their marketing is top-notch, so I think they're a really good option for 2021. Let's have a look at the chart right now and also the share price. So at the moment, filming this video, it's trading at $5.79. It has definitely come off the highs of the IPO. As you can see, it hit into the $7 region and it has a market cap of $544 million. Now guys, I believe that this may have a little bit more to drop, but I think around that $5 mark or even $5.50, it's a really good buy for the longer term. Obviously the PE ratio there looks staggering, but you've got to remember this is a fast-growing company. It's going to grow into that multiple, and you need to, with these sort of businesses, look to the future, look at things like revenue growth and earnings growth as well. Don't necessarily expect them to turn any massive profit really quickly. They're reinvesting in their business as they should. So my investment case, guys, ABY is an e-commerce play on the ASX in a large category, okay? I like the fact that it's an e-commerce play. There's not many of them on the ASX, and it's definitely where we're seeing some massive growth come. I'm sure I don't need to tell you about Amazon, Shopify, and big brands like that, big businesses related to e-commerce. So these guys are playing in a space that's huge, and the niche that they're in, beauty and personal care, it's worth a whopping $10.9 billion in 2019, and it's growing really fast. A really interesting fact, and I spoke to my girlfriend about this one, guys, is a lot of women find going to the beauty counter actually a little bit intimidating. I have left off the end there. They find it intimidating. They prefer it once they know the brand they want, they just buy it online. These companies that sell beauty products in a store employ really attractive women, and sometimes people can feel really intimidated by it and just don't want to go into store. So these sales are going to accelerate massively. And look, COVID accelerated the shift to online in a big way. Online beauty sales have gone from 7% to 25% of sales, okay? So online is picking up fast. It's a category that will get high penetration due to being dominated by brands, guys. People know once they buy it once, they know what they're going to buy. They're just going to shop on price, availability, and things like that. This company has ambitious growth targets, guys. Revenue set to grow at 76% and profit at 150% over the next year. The founders still own a good portion of the shares, so I don't believe they still run the company anymore. There's a different CEO, but they own over 20% of the shares, which I like to see, and they're also directors of the company. So this was actually founded in a ladies' garage in Melbourne, which is an amazing story. I like things with a good story. It's also exceeded the prospectus forecast by 7% in their recent update, so already trading above what they said they were going to do. So that's ABY, guys. Definitely worth adding to your watch list for 21. The next one is Aristocrat Leisure. A lot of you have probably used their pokey machines if you've been to the pokies. These guys obviously make the pokey machines, the software, and they also have bought a business in online mobile games and online gaming, right? So a big part of their growth is coming from that section of the business. So gaming machines obviously have suffered a little bit with COVID, but the mobile gaming services and web gaming services are doing really, really well. This did get hit particularly hard, which I'll show you in the chart. As you can see, during COVID, it went from the high 30s, low 40s, all the way down to almost $19, which is a big, big drop. In saying that, though, it has had a really good track record over the last 5 years. So it's definitely been climbing quite aggressively. It is a growth company. At the time of recording, it's trading at $31.77. It's got a market cap of $20.28 billion, and it's got a PE of only 14.71 at the moment, according to Yahoo Finance, and it's got really good EPS growth, guys. It also does pay a small dividend. So why do I think ALL should be added to your watch list for 2021? COVID restrictions, guys, will eventually ease. We're already seeing that. And sales in the casino portion of their business should improve, especially in Australia, which has contained the virus really, really well. So they sell a lot within Australia. This should recover quite fast. The digital gaming section of this business is growing at almost 30%, guys, so really, really fast. It's well placed to continue the strong growth. The management team have a really good, strong history of delivering strong performance and pivoting to grow the business. They could have just sat there, been stale, and kept on delivering casino machines, probably still made good money, but they've pivoted to online and mobile gaming, and this is a really good sign that management knows what they're doing and knows when to pivot. The reason this is good, guys, is it tells us in the future that they're probably going to make more good decisions. Another factor here is big brokers such as UBS and Macquarie are really bullish on this stock, which is always a good sign. So, guys, that's why ALL should be added to your watch list. The next company is A2 Milk. We have covered this off on the channel in another video, but basically, guys, it's a premium branded dairy nutritional company. Realistically, it's mainly a formula company, so a baby formula company, if you will. They do sell some other milk products as well, but 85% of their business comes from the baby formula. Basically, the products contain the A2 beta casein protein type. It's more easily digested, and reality, they're a great marketing company, guys. They also sell some liquid milk, powdered milk ice cream, and obviously the infant formula. So as you can see, they've had a really big drop off of late. China tensions, COVID, lots of things have impacted this business of late. It's still growing really fast, guys. Don't be scared by that PE. This is one of the few companies that have been going really, really well over the last 5 years that actually generates serious amounts of money. So why should A2M be added to your watch list for 21? It's down over 30% from all-time highs due to a recent trading update, guys, where they highlighted, I believe, to be a few temporary COVID-19 related issues. So remember when COVID first happened, the pantries got stocked heavily. People are now using that product and destocking their pantries, which means that they're not buying as much now. We've had issues with the Daigou channel, so there's been less Australian tourists and less international students buying the product here and taking it back to China. Victoria lockdowns also impacted it. So guys, this is very fast growing, very high margin business with a product that's high in demand and got a strong brand. The China issues, the political issues, these should drop off at some time. They cannot last forever. So it's always a good time to buy this stock as it goes through a lot of cyclicality. So buying dips on this, I've made a lot of money doing that. It's got a really strong balance sheet, guys, and it generates tons of cash, and it's in great financial health. So that's what we want in an investment, something long-term. So that's why you should add it to your watch list. The next company, guys, is Bid Energy, ASX ticker BID. It's a technology company which provides global utility spend management services through the deployment of its cloud-based software platform. So basically, if you're a company and you have multiple meters out there, multiple locations, power bills are a huge expense for you. So you can monitor all these, make improvements, and really save some money through their app platform. It could be a massive headache. So think of a big company like Coles and Woolworths. They've got several hundred, if not thousands, of stores, and they want access to all these utilities at the drop of a hat, right? So this tells them in real time what they're spending, allows them to account for things better. So saves them money, which is a great thing, and it's a SaaS product, so something that I really like. So it's had a pretty good run of late, guys. It did drop off due to COVID, but it's definitely come back. It's got a market cap of 150 million. Obviously, no PE ratio, doesn't currently make a profit, but this is something a bit more speculative, guys. It does have a lot of cyclicality. It will be up and down, but it's a company that definitely saves people money, and so I like it. I think next year could be a really big year as they have some big growth plans in place. So the main reason, guys, it solves a series of expensive, time-consuming problems for multi-locational businesses with utility expenses, okay? So someone's got utility expenses. These guys help save time and money. It's capable of processing thousands of utility bills per minute and removes manual and costly human interventions. It also allows people to track and reduce their power bills, which is awesome for those bigger companies, and also smaller ones with multiple locations. What I do like, guys, it's already used by a number of large brands all over the world, including Flight Centre, Cotton On, Optus, and a lot of other ones you've seen. Just go on their website, tells you all about the businesses they already deal with. It's a sticky, high-margin SaaS product, so once someone signs up with them, they're unlikely to change, guys. It's saving them money, so what's the incentive for them to change there? They're obviously getting ongoing revenue paid as it's a SaaS product, and on top of that, they are adding additional services over time to continue to sell to people. So I want to see strong new customer growth and meters added here, guys. They're the two metrics to look at within their reports. It's currently not profitable, so one to hold for a few years, but definitely worth a watch next year. The next company, guys, is Bingo Industries, ASX ticker BIN. They're a waste management and recycling company, and they've got operations that are spread across building, demolitions, commercial, industrial waste, with capabilities of waste collection, processing, separation, and recycling. You guys are probably thinking a bit of a boring company, but definitely very safe, guys. As you can see, they've had a pretty good run up post-COVID. They're not a small company, $1.69 billion market cap, P ratio of 25.9, and they do pay a dividend. My investment case for this is pretty simple, guys. Bingo has a leading market position in two of the strongest states of Australia, Victoria and New South Wales, for waste generation and economic growth. So both of these states produce the most amount of waste and also have the strongest economic growth. Expanding within current states, which is awesome to see in different areas and regions, and they're looking to expand into Queensland in the future. It's got a robust business that performs well regardless of the economic cycle, so minimal impact from COVID, has been a little bit, but not as much as other businesses because people still need waste collected. They've invested in infrastructure to allow for future growth as well, guys. They still have an additional 35 to 40% capacity with no further investment needed. So the problem with these types of businesses is they're capital intensive and people need to keep investing in them to grow. So they've already done that investment, so there's plenty there of capacity there for them to grow. The other thing, guys, is government waste levies are increasing, so Bingo's resource recovery and recycling will grow because people want to avoid paying those waste levies. The next company is ASX ticker EOS. EOS is Australia's largest aerospace entity and the largest defence exporter in the Southern Hemisphere. So a pretty cool company, not a lot of people have heard of. It's currently trading at $6.39. It's almost got a market cap of $1 billion. And as you can see, it's had a decent run up, had a huge one pre-COVID, and hasn't quite recovered. My investment case for this is it's got strong revenue growth of 31% at the last update. So sales are growing quite quickly. COVID has caused supply chain disruptions and custom orders to be pushed back. This should be temporary as management has reaffirmed guidance in their last report. The current geopolitical climate plays in their favour, so governments are going to spend more on defence, and this being a defence company will benefit from this. Australia, for example, is increasing spend by $70 billion over the next 10 years, so that's $7 billion additional per year. So they're going to be spending $270 billion over the next 10 years, guys. These guys have plenty of new contracts in the pipeline and infrastructure of plants ready to scale. So they are a global company. They deal with a lot of US defense contracts as well. So great little business here, guys. one to watch, one to do a bit more digging into. So Fortescue Metals is the next company, ASX ticker FMG. It's an iron ore production and exploration company located in the Pilbara region of Western Australia. So these guys go up against Rio Tinto and BHP in the iron ore industry. It's had a terrific run up, guys, but have a look. The PE ratio is still very undemanding at 14.17. Still has an awesome yield, and it's growing really fast. I do expect a small pullback at some point, probably to sit between $18 and $20, somewhere there. Great buy at that point. This is a well-run company, guys. It's got a great yield, as I said, of over 8%. It constantly innovates to reduce costs and keep productivity high. Global steel production is recovering, guys, so iron ore is needed to make steel, and it's expected to grow in 2021. Southeast Asia and India are increasing as well, so definitely another factor to play in there. It's not just China. So there are risk of China tensions, but unlikely due to the need of iron ore. Australia provides China with most of their iron ore needs, so they need it to create their steel, so it's unlikely until China gets a lot of their mining up and running, and even then they're still going to need more steel, so our iron ore is going to be in demand. Another reason it's had a really good run and will continue to do so is Brazilian miner Vale downgraded production forecasts, and so the price has spiked. So the next company is ASX ticker MQG, which is Macquarie. It's a global provider of banking, financial advisory, investment, and fund management services, and it's headquartered in Sydney. So it's Australia's only investment bank. It's trading at $139.95. It pays a small dividend of 1.9%, and it's got a PE ratio of 22.54. So unlike our boring other banks that really just invest in mortgages, Macquarie is a truly global investment bank. It's got much better margins and higher returns on capital than traditional banks. It's got good exposure to earnings outside of Australia. 2/3 of the earnings actually come from overseas. And it's got a strong track record of sales and earnings growth. It's a great play on the recovery and value rotation trade that's going on at the moment, guys. So definitely worth adding to your watch list, Macquarie. The next company on my radar, guys, is MyDeal. Again, if you want more info on this, it's in another video. MyDeal is an online e-commerce retail marketplace. So basically, online marketplaces such as MyDeal, guys, connect merchants, which are the sellers, with consumers, and they don't have to hold a lot of inventory or have big warehousing in place. They are moving into their own ranges of products slowly, which should add some more growth for them and margin. So MYD is definitely worth adding to your watch list. It's trading at 121.5. It peaked at a massive $2.20 on the day it IPO'd. The IPO, I believe, was at $1, so it's trading about 20% above that. It's got a market cap of $314 million, and yeah, expect some big things out of this company, guys. It's one of the few, again, pure play e-commerce plays in Australia, and it's a marketplace, so slightly different to a lot of traditional e-commerce stores. Australia has a long way to go with online furniture buying adoption, guys. That's MyDeal's main category is furniture, and it captures, and if MyDeal is able to capture a bigger portion, so in the US and UK, it's 16% of total sales in furniture are done online. Australia only has 5%, so about 3 times of the pie to grow there. It's a capital light business model, so money made by seller fees charged is where they make most of their money. But they are, as I said, moving into their own private brands, which should be a big boost to their revenue. Great post-IPO update. So sales up 317% and customers up 268%. So more customers, but all those customers bought more as well. It's got a huge database with great marketing driving lots of return purchases, guys. 50% of the last quarter's purchases were actually repeat purchases. So remember, in this, marketing is a big cost. If they're not having to market as much and pay to get more customers and the existing customers keep buying, that's awesome for them. They're not going to have to spend as much. COVID has obviously accelerated the adoption of online shopping. And the other great thing, guys, directors just bought more shares at $1.29. So even higher than the current share price, which is a good sign. MyPhysIQ, guys, or ASX ticker MYQ. It's an AI-powered body measurement composition app or software right from your smartphone. So they license this software to other app developers who want to measure body composition. So think fitness apps, think telehealth. Think insurance companies. All these people want you to scan your body. They'll then assess risk or determine, different exercise for you to do, different foods, etc. It's trading at $1.18 at the moment, guys. So it is well off its highs. It's definitely had a little bit of a pullback and looking to enter a new uptrend. It's got a market cap of 141 million, so it is on the smaller end, but big things coming for this company. What I like about MIQ is they have a patent over the biometric scanning technology on an iPhone, which is awesome. Potentially a huge addressable market here, guys. Tons of health and telehealth apps with big user bases could use it. Insurance companies are also being targeted to improve their underwriting. So if insurance companies know more about your health, they can provide more accurate pricing at a personal level. So it signed some really big contracts recently and is very close to profitability. Quite a big deal just signed in early December. Recent capital raise at $1.20, which gives them a lot of cash to execute. And they're looking to list on the NASDAQ as well, which should bring increased attention. So, and there's also tons of takeover and company activity in the health tech space. Really big industry, which is growing, especially with the new normal post-COVID. So really big growth runway for these guys. Now, guys, my favorite gold company on the ASX is Northern Star Resources, NST, pure play gold production exploration company with a resource base located in the gold regions of Australia and North America. They bought, I believe, last year a giant mine in Canada. These guys are great, guys. I bought this stock at $2 and I sold it around the $10 mark. I continue to trade in and out of this as well, but I think it's a great long-term hold. Northern Star is trading at $13, guys. Looks like it's in a bit of a downtrend. I wouldn't be surprised if we see it in the 10s or 11s. At that point, I'm definitely a big buyer. It's got a $9.6 billion market cap, and it does pay a small dividend. My investment case is pretty simple. It's an extremely well-run gold miner with a good track record of delivering shareholder value. It's also got a really great balance sheet, guys, often buying things in cash and has quite low levels of debt. At one point, it had no debt for quite some time. Unprecedented monetary stimulus and money printing should result in much higher gold prices, guys. So the more money they print, the more valuable gold will become. We are still in turbulent times and gold is a flight to safety. So it's good for any portfolio to have some exposure to gold. The next company we're looking at, guys, is Nitro, ASX ticker NTO. It's a global document productivity software, the Nitro Productivity Suite, which provides integrated PDF productivity and e-signature tools to customers through a SaaS desktop-based software suite. So think it's a competitor to Adobe Acrobat if you use that, and also a competitor to DocuSign, the US company. It's trading at $2.90, has a market cap of $552 million. Given it is quite a new company, guys, it's only recently listed, so there's not a lot of history. Definitely a bit more on the riskier end. My investment case, though, is it's an alternative to two giant offerings, Adobe and DocuSign. Huge markets here, particularly post-COVID. Roughly 90% gross margins, which is incredible, guys. So they've got plenty of margin there to play with to drive new customers and continue to grow. It's a founder-led company, which is what I like to see. It's got net revenue retention at 118%. So growth from existing customers, if you will, is 18%. It's got no debt and great marketing team with a strong history of growing tech companies, guys. Great management and marketing, I should say. They just attracted some great talent to the business. So I have high hopes for this business, and it's great to see an Australian tech company doing well. Nuix NXL is a really recent IPO listing. They basically provide analytics and intelligence software. It's been used in a lot of big investigations, guys, such as Panama Papers, Royal Commission into Misconduct Banking, and lots of other ones. This is quite a hot IPO at the moment, guys. Definitely one worth looking into, being in the cybersecurity space. It's trading at $8.50. Not a lot of history there, so I'll move on to my investment case. Basically, it automates the once labor-intensive task of reviewing large amounts of data in investigations. So think about people used to have to sit there reading emails, texts, browser history, and it took so much time, guys. The companies send it all over, upload it. Their software goes right through it, and AI obviously tries to pick patterns and then it relays and creates that information into easy to read format, right? Gives them, I guess, all the key things out of that data and summarizes it in a nice, easy to digest format. I like that it's a SaaS subscription model, guys, with very high margins. Obviously sticky as well. It's got a low churn rate, and existing customers tend to spend more on an ongoing basis. They've improved their messaging and sales efficiency as, over time, looking at their prospectus, every dollar of sales, they're continuing to generate more money, which is awesome. And post the IPO, they've got absolutely no debt, which I love to see. And Excel is definitely worth looking at. The next company is Objective Corp, OCL, another IT software company. As you can see, a trend, something I like. It provides content collaboration and process management solutions for the public sector. So it really helps government departments and other public sector entities have better management tools and then transform the way they deliver the services that they do. It's trading at $12.85. It's had a cracker of a year. Market cap of 1.2 billion, but I see a lot of growth on the horizon, guys. They still haven't cracked into a lot of other areas that they could within the government departments. They're actually starting to transition to sticky recurring revenues, which is what I like to see. They should get rewarded with a better earnings multiple because of this. It's a fairly safe mission critical government contract space they play in. So regardless of the economy, once they get these jobs, the government is going to pay them. It's a beneficiary of COVID and the shift to work from home, as more of these departments do work from home and need tools such as this to better govern and operate. Essentially sells an add-on to Microsoft Teams, which saw a huge growth in user base from 20 million to 75 million users. So, it's a lot. There's 55 million users added during COVID, and these guys obviously sell an add-on to that. So it's got a strong runway for growth with new products in development, and they're spending plenty on R&D. So plenty of new stuff to come in this space. So OCL will be a beneficiary of this, and definitely worth adding to your watch list. Company I really like, guys, PainCheck. It's an intelligent pain assessment tool. So it's a mobile app that automates and scans someone's face and will tell a carer or hospital staff or aged care worker what level of pain someone's in for someone who can't communicate it. So people with dementia or children who can't speak. It's currently trading at 8.1 cents. It's got a $91 million market cap. Obviously a bit more of a speculative buy, but definitely something worth looking at. I'll get into my investment case right now. So it solves an emotional and a large problem. So emotional problems often are easier to sell. 400 million pre-verbal children and 50 million people living with dementia. So huge space that they operate in. It's obviously going to save time, money, and give people better health outcomes. It's got regulatory approval in many countries and in the process of getting it in the giant USA. Sales cycle is slow due to COVID, which isn't good, as many aged care homes have been closed, right? And it's well off its highs, and brokers have targets at almost 5 times higher what the share price is right now. So a lot of people are seeing that this is a good company and expecting big things out of it. So the next company is PushPay, or PPH. They provide a donor management system, including donor tools, finance tools, and a custom community app to the faith sector. So essentially churches. It's trading at $1.78. It did have a stock split recently, so that's why you might see different prices out there. It's got a market cap of 1.97 billion. Obviously a high PE ratio, but they're growing fast, guys. So the huge shift to cashless society has been made even faster due to COVID. It plays right into the cashless society. People can make donations through the app, and the app allows and encourages people to make more donations. They had a great update recently. It's growing very fast. So 48% rise in volumes processed, 53% increase in revenues. Recent church management SaaS acquisition is exciting. So they're going to be able to provide a full church management solution to people. It's a huge addressable market, guys. So in the US, donations are at 50 million. These guys only have 10% market share in that space and looking to get more. Management is moving from the growth to monetization phase, so we should start to see earnings grow rapidly over the next few years. The next company, guys, is realestate.com. So REA provides property-related advertising services on websites and apps across Australia. It has entered a bunch of other finance-related services as well, so it is expanding out. It's trading at $142. It's got an $18.8 billion market cap, EPS of 0.85. It's got a high PE ratio, obviously, guys, but the market in the property market in Australia is the place to invest. Realestate.com is the place to advertise a house for sale or rent. They have the market by the proverbial balls. So definitely going to keep growing as our property market goes gangbusters. In saying that, though, they kind of win regardless of the cycle. The only time they don't win is when listings are down, right? But they do have a lever. Price, okay? They're able to charge virtually whatever they want because you need to advertise there. Agents need to advertise there. It's an extremely resilient business model. Despite COVID and a housing downturn, they continued to grow. So that's a really good sign. They went through two big things, kept growing. It's the place to advertise homes for sale and rent in Australia. Australia is a house crazy nation. That is our main form of investment. Easily able to increase prices, as I said, and has been adding additional revenue streams such as finance-related loans and things like that. Housing has rebounded strongly, so they should continue to benefit. The next company is Reece Plumbing, guys. So REH, they provide plumbing supplies, guys, and a range of other things in the trade, retail, professional, and commercial markets. It's trading at $14.82. Again, a similar play to realestate.com. These guys have the plumbers market cornered. So great little business, $9.57 billion, guys, pays a small dividend. They've got a really long track record. They've actually been around for over 100 years. Good sales and profit growth in the recent update. A lot of core plumbing products are in constant demand, guys, so it's a pretty safe company. Despite whatever the economy is doing, people are going to be buying these plumbing supplies. Think about, if a toilet breaks or pipes break, they need to get fixed immediately. Housing has been rebounding strongly in 2021, guys. So again, this should play into their favor. Lots of building happening. Governments are spending a lot more in stimulus for first home buyers, and this will generally benefiting housing, guys. So a lot of the policies out there, low interest rates, this will benefit housing, which will benefit Reece. So a great company to add to your watch list. So the next play is Talga Resources. They basically provide battery anodes, graphene additive products. So this is an electric vehicles play, basically. Trading at $1.78, has had a big run, so expect a pullback, guys. Maybe buy in around that dollar mark. It's probably not a bad buy, $1.20. It is obviously a smaller company at $433 million, but as I said, expect a pullback. Definitely a good long-term hold, though. So great thing about them, guys, is if you want to play EV, these guys have a product that's in demand. It's coming from a tier 1 mining country, being Sweden. They've got a good track record of producing high quality products. So huge growth in the EV and battery materials market. Obviously, lots of Teslas being sold. These guys need more graphite. Very, very simply, their latest project, Niska in Sweden, is looking promising and would make it, once they complete this project, it's going to make them the largest graphite producer. They have another project as well that's already up and running, but this new one is looking really promising. So Talga, definitely add TLG to your watch list. The next company, Whitehawk, ASX ticker WHK. It's basically a cybersecurity company. The company offers an online tool that enables small and mid-sized businesses to take immediate action against low to mid-level cybercrime, fraud, and disruption. So this space is growing massively, guys. Companies like this are very exciting. Currently trading at 27 cents, has a $42 million market cap. So they've got multiple major supply agreements with US federal government departments, so definitely a strong case for an investment. Plenty of agreements in the works. Cybercrime and securities front and center of a lot of business minds and consumers. Experienced management team with plenty of experience at high levels of government, which is what you want to see when they're trying to target government departments to get contracts in them. They've also got plenty of cash on hand, guys, which is awesome. Whitehawk is definitely one to add to your list to watch. Next company, guys, Wiser, WZR. These guys provide a unique financial wellness ecosystem pinned by financial products. It's a fancy way of saying they're an online lender, basically, guys. They tend to have much better rates than the banks, and they target consumers who have a good track record that just want to borrow some money. It's currently trading at 20 cents. It has been stuck in a bit of a sideways pattern, so definitely expect it to either move downwards or upwards sometime soon. It's got a $219 million market cap. It's fast growing, guys. Revenue was up 358%, loans up 132%. So it's obviously doing bigger loans. Its app and ecosystem utilizes modern technology to lend money fast. So it's neo-banking or lending, which is obviously on trend. It's building a strong B2B channel, which is awesome because this should see much bigger volumes go through and more loans. It's got great marketing and branding, Facebook, Instagram, Google. Clearly investing for growth, guys. They're spending plenty of money on this. Being a marketer myself, I can see it. 90 days in arrears is trending down, which is always good for lenders. They're lending to desirable and creditworthy customers who are making over $86,000 a year, so they're far less likely to default. It's got a huge addressable market, $39 billion in unsecured loans annually and $80 billion in secured vehicle funding. If they can just capture some of that market share, they're going to do very well. Guys, thank you so much for watching my video. I hope these 21 stocks will help you start your share market research. If you liked the video, please subscribe, hit that notification bell, give me a thumbs up. I'll see you all in the next video.